Ohio was supposed to be different. The affordable heartland. The place where the American dream still made sense. Where a teacher and a nurse could buy a house, raise kids, build equity. That story, it's crumbling faster than anyone predicted. Right now, across the Buckeye State, housing markets that survived the 2008 crash are imploding. Not cooling, collapsing. We're talking double-digit price drops, inventory explosions, and sellers slashing asking prices by $50,000, $75,000, sometimes more, and still getting no offers. The equity millions of families thought they had, vanishing. The stability retirees counted on, gone. And if you think this is just a correction, you're not paying attention. Today, we're counting down the top 10 Ohio cities where the housing market isn't just struggling, it's in full meltdown. These are places where the warning signs everyone ignored in 2024 and 2025 have become a full-blown crisis. From former manufacturing titans to Sunbelt wannabes that overbuilt themselves into oblivion, these cities are facing a reckoning that will reshape Ohio's real estate landscape for a generation. Why does this matter right now? Because if you own property in these markets, every day you wait costs you money. If you're thinking about buying, understanding which dominoes are falling and why could be the difference between getting the deal of the decade or catching a falling knife. This isn't fear-mongering. This is data. This is reality, and it's unfolding in real time. If this channel saves you from making a catastrophic real estate decision, hit that subscribe button. We're bringing you ground-level data. No sugarcoating, no realtor spin. Just the truth about what's really happening in housing markets across America. Let's dive in. Number 10. Lima. Lima was once Allen County's industrial heartbeat. Ford Lima engine plant, refinery jobs, blue-collar pride, not anymore. The median home price in Lima has dropped 11.8% year over year, falling to $118,400 from $134,300 just 12 months ago. Inventory has surged 73% since January 2025. Homes that once sold in 32 days are now sitting for 89 days, the longest in 15 years. And here's the kicker. 34% of listings have had price reductions in the past 90 days alone. These aren't small cuts. We're talking $15,000, $20,000 off asking prices that were already low. But it's not just the numbers. The reason? Jobs. Ford's Lima engine plant has been scaling back operations since late 2024, with layoffs hitting 200 workers by March 2025. When you lose that kind of employment anchor in a city of 35,000, the housing market doesn't soften, it seizes. And then, there's the refinery sector. BP's Lima refinery announced restructuring last summer. Translation: fewer positions, lower wages, uncertain future. What's making it worse? The rental market is simultaneously collapsing. Landlords who bought investment properties during the 2021-2022 boom are now competing with each other in a shrinking tenant pool. Monthly rents have dropped from $895 to $715 for two-bedroom units. Property owners are hemorrhaging cash, and many are panic listing, flooding an already oversaturated market. Who's suffering? Families who bought at the peak in 2022 are trapped. They owe $145,000 on homes now worth $118,000. That's $27,000 in negative equity before closing costs and realtor fees. They can't sell without bringing cash to the table. They can't refinance because they're underwater. Teachers at Lima Senior High, nurses at Mercy Health, retail workers at Lima Mall. These are the people stuck, holding the bag, paying mortgages on depreciating assets, while watching their neighbors' homes sit empty for months. Investors? They're fleeing. Out-of-state buyers who scooped up properties sight unseen in 2021 are now trying to unload them at any price. Banks are pulling back too. Mortgage approval rates in Allen County have tightened by 23% compared to last year. Lenders see the writing on the wall. Lima's market is toxic right now, and they don't want the exposure, and it's only beginning. Local economists predict Lima could face an additional 8 to 12% price decline through 2027 as the full impact of industrial job losses ripples through the community. The city, that once promised working-class stability, now faces a decade of stagnation, or worse. Number 9. Springfield. Springfield sits in a category all its own. The cautionary tale nobody wanted to write. Median home prices have crashed 13.2% in 12 months, dropping from $142,600 to $123,800. Listings have exploded, up 81% since last winter. Days on market? 94 days average, up from 38 days in early 2025. According to the Springfield Board of Realtors, 41% of active listings have reduced their asking price at least once. Some twice, some 3 times. Sellers are desperate and buyers can smell it. But it's not just economic. The reason? Population exodus paired with collapsing public services. Springfield lost 3.2% of its population between 2023 and 2025. Over 1,900 residents in a city of 60,000. Schools are consolidating. The Clark County tax base is shrinking. And when local government services degrade, property values follow. Crime rates spiked 17% last year, according to FBI data. Nobody wants to invest in a community where police response times are stretching and infrastructure is crumbling. What's making it worse? The collapse of major employers. Navistar's Springfield plant, once employing over $2,000, has been gradually downsizing since 2023, with the final closure announced for late 2026. When that happens, the remaining jobs will evaporate. Retail, restaurants, services, all dependent on those manufacturing paychecks. And then there's the opioid crisis that never ended. Springfield has one of Ohio's highest overdose rates, and the stigma is real. Buyers from Columbus or Dayton see the headlines and cross Springfield off their list. Families who bought in North, Hampton, or Snyder Park in 2021 are now paying $1,340 monthly on mortgages for homes worth $28,000 less than they owe. Before insurance, which has jumped 34% in 2 years. Before property taxes that haven't adjusted downward despite plummeting values. These aren't rich people. They're firefighters, grocery store managers, dental hygienists, middle-income earners who believed the housing market was a safe bet. They were wrong. Sellers are offering incentives nobody wanted to see. $5,000 toward closing costs, free home warranties, even offering to pay the buyer's first 3 mortgage payments. It's not working. Inventory keeps piling up. Every week, new for sale signs appear in neighborhoods already littered with them. The market psychology has flipped from cautious to panicked. If you're watching this from Springfield, tell us, what are you seeing on the ground? Are your neighbors listing? Are prices dropping even faster than the data shows? Drop a comment because this story is still being written and it's getting uglier by the month. Number 8. Mansfield. Mansfield was Richland County's anchor. Manufacturing heritage, affordable living, stable, if unspectacular. That stability shattered. The median home price in Mansfield has plummeted 14.1%, falling to $129,700 from $151,000 a year ago. That's a $21,300 loss for the median homeowner, money that simply evaporated. Inventory is up 88% since January 2025. Days on market have stretched to 97 days, the longest since 2011. And according to local MLS data, 46% of listings have seen price cuts, some as steep as $35,000 from original asking prices. This isn't a soft market. It's a fire sale with no buyers. But it's not just one factor. The reason? Demographic collapse and industrial decay happening simultaneously. Mansfield's population has declined every year since 2020, losing over 2,400 residents, 5.3% of the total. Young families are leaving for Columbus, Cleveland, or out of state entirely. Who's left? Aging homeowners on fixed incomes, and those too financially trapped to leave. That's not a recipe for housing market recovery. It's a death spiral. Even more concerning, Mansfield's largest employers are either downsizing or shuttering. Gorman Rupp's local operations have cut 18% of their workforce since 2024. The Richland Mall, already barely alive, lost its last anchor tenant in October 2025, leaving a massive commercial dead zone in the heart of the city. When retail dies, everything connected to it withers: property values near commercial corridors, tax revenues, city services. And then there's the infrastructure. Mansfield's water system has had 3 boil advisories in the past 18 months. The roads are potholed, the schools are underfunded. Who wants to buy into that? Homeowners in areas like South Park or near Maplewood are trapped in equity nightmares. They bought at $155,000 in 2022. They owe $148,000. Their house is now worth $130,000. They're $18,000 underwater, and that gap is widening every quarter. Monthly mortgage payments of $1,285 suddenly feel astronomical when you're living in a depreciating asset with no way out. Service workers, administrative staff, social workers, these are the people drowning in Mansfield's housing collapse. Investor behavior ruthless. The few institutional buyers who entered Mansfield's market in 2021-2022 are dumping properties at losses just to get liquid. They'd rather take a $22,000 hit now than hold through another year of decline. Local banks are quietly tightening lending standards. They know what's coming: foreclosures. When homeowners can't sell and can't afford to hold, they walk away. We're only halfway through. The real threat: Mansfield could lose another 10 to 15% in home values by 2027 as the population outflow accelerates and more businesses close. The city that once offered heartland affordability now offers something else: financial quicksand. Number 7. Youngstown. Ground zero for America's industrial collapse. The poster child for Rust Belt decay. And now, the housing market is confirming what everyone already knew: this city is dying. Median home prices have dropped 15.3% year over year, falling to $80,400. Read that again: $80,400 for a median home in an American city. Inventory has surged 94% since last winter. Homes are sitting an average of 106 days, triple the state average. Nearly half of all listings, 48%, have had price reductions, and sellers are still getting ghosted by buyers. You can find 3-bedroom houses in neighborhoods like Idora or Cornersburg listed under $70,000. And nobody wants them. But it's not just economic decline. The reason? Total systemic failure. Youngstown has lost 65% of its population since 1960. The trend hasn't stopped. Between 2023 and 2025, another 1,800 residents left. The city now has approximately 58,000 people living in infrastructure built for 170,000. Schools are consolidating at an alarming rate. Entire neighborhoods are being abandoned block by block. When the city government can't maintain basic services, streetlights, snow removal, police patrols, property values don't just fall, they collapse. What's making it worse? The poverty rate in Youngstown is 35.2%, one of the highest in Ohio. Median household income is $31,400. Do the math. Who's buying houses when a third of the population lives below the poverty line and the median earner can barely cover rent? The labor market is anemic. Youngstown State University is the largest employer, but that doesn't support a housing market. Manufacturing jobs, the backbone of the economy for a century, are never coming back. Period. And then there's the crime. Youngstown's violent crime rate is 1.5 times the national average. Property crime? Twice the national average. Buyers research this before visiting. They see the statistics and decide they'd rather pay more for safety somewhere else. The few investors who tried to flip properties in Youngstown are now sitting on inventory they can't move. Rental properties are staying vacant for months. The math simply doesn't work. Families who own homes in neighborhoods like Lansingville or Sharon Line are in impossible situations. They bought for $105,000 in 2021. They owe $98,000. The home is now worth $85,000. They're underwater by $13,000 and falling. Monthly payments of $920 might sound cheap, but not when you're paying for a depreciating asset in a city with no economic future. Factory workers who thought they'd build generational wealth through home ownership are realizing they've been financially trapped. Sellers are beyond desperate. Offering seller financing. Accepting lowball offers $30,000 below asking. Throwing in furniture, appliances, cars, anything to get out. It's not working. The market is frozen. Banks won't lend on properties they know will be worth less in a year. Appraisers are coming in below contract prices, killing deals even when buyers do appear. The future? Youngstown could see prices fall another 8 to 10% by 2027, potentially dropping median values below $80,000. At that point, it's not even a housing market anymore. It's urban decay with mortgages attached. The city that once powered America now faces complete irrelevance, and the housing market is the proof. Number 6. Toledo. Toledo sits on the western edge of Lake Erie, once a manufacturing powerhouse, a logistics hub, a place where the Midwest dream still felt possible. Not anymore. The Glass City is shattering. The median home price has dropped 16.4% in the past year, falling from $158,300 to $132,400. That's a $25,900 loss per median homeowner. Wealth that simply disappeared. Inventory has exploded by 97% since January 2025. Days on market have stretched to 112 days, up from 41 days last year. According to the Toledo Area Board of Realtors, 52% of active listings have reduced their asking price, with some properties seeing 3 or 4 cuts before finally selling or being pulled from the market entirely. But it's not just numbers. The reason? A perfect storm of economic stagnation, population decline, and insurance chaos. Toledo has hemorrhaged residents for 2 decades, losing nearly 30,000 people since 2000. The outflow accelerated in 2024-2025 as younger workers fled for Cleveland, Columbus, or out of state entirely. Who's left? An aging population on fixed incomes, and those without the resources to relocate. That demographic can't support a housing market. It can only watch it collapse. What's making it worse? The Jeep plant, Toledo's largest private employer, announced a shift reduction in late 2024, cutting 2,400 jobs. When auto workers lose paychecks, everyone else suffers. The restaurants near the plants, the retail at Franklin Park Mall, the service providers throughout Lucas County. And then there's the insurance crisis that nobody predicted. Home insurance premiums in Toledo have spiked 41% since 2023 due to Great Lakes, storm risk, aging housing stock requiring expensive repairs, and insurers simply reassessing risk. Monthly insurance that was $145 is now $205. That's $720 more per year, on top of mortgages and property taxes, and it's breaking budgets. The human impact is devastating. Families in neighborhoods like Old Orchard or Ottawa Hills who bought in 2022 are now trapped. They paid $165,000. They owe $157,000. Their home is worth $135,000. They're $22,000 underwater. Monthly housing costs, mortgage, insurance, taxes have climbed to $1,580. For a teacher and a retail manager, that's 48% of their take-home income. They can't afford to stay, can't afford to sell, can't refinance out of the trap. Financial paralysis. Investor behavior has turned predatory. Corporate buyers who scooped up Toledo properties in 2021-2022 are now dumping them at 15-20% losses just to avoid holding through another year of decline. Local landlords are panicking as rental demand softens. More people are leaving Toledo than arriving, and those who stay are doubling up to save money. Vacancy rates for rental properties hit 11.3% in Q4 2025, the highest in a decade. Banks are tightening. Mortgage denial rates in Lucas County jumped 27% year over year. Lenders don't want exposure to a market where values are cratering and economic fundamentals are weak. Appraisals are coming in below purchase prices, killing deals. Sellers are offering $7,000 toward closing costs, 1-year home warranties, even paying buyer HOA fees for a year. Nothing is working. The market psychology has shifted from "let's make a deal" to "how do I get out before it gets worse?" Toledo's future is bleak. Economists predict another 10 to 14% decline through 2027 as the population exodus continues and the auto industry's Ohio footprint shrinks further. The glass city that once symbolized American manufacturing might now faces decades of irreversible decline, and its housing market is leading the way down. Number 5. Dayton. Dayton was the birthplace of aviation. The Wright brothers. Innovation. Midwest ingenuity. That legacy? Crumbling into dust as fast as the housing market. Median home prices in Dayton have collapsed 17.8%, dropping from $167,200 to $137,400 in just 12 months. That's nearly $30,000 in lost equity for every median homeowner. Inventory has surged 103%, more than doubled, since the beginning of 2025. Days on market have ballooned to 118 days, the longest since the Great Recession. And here's the nightmare statistic. 57% of listings have had price reductions. Over half. Sellers are slashing asking prices by $20,000, $40,000, sometimes $50,000 or more, and still watching buyers walk away. But it's not just a market correction. The reason? Economic hollowing combined with systemic urban decay. Dayton has lost 45% of its population since its 1960 peak of 262,000 residents. The current population sits around 138,000 and falling. Between 2024 and 2025 alone, Dayton lost another 2,100 residents. When a city loses population that rapidly, everything breaks. Tax base, public services, infrastructure, schools, safety. Property values don't soften, they crater. Even more concerning, the military's role is shrinking. Wright-Patterson Air Force Base, Dayton's largest employer with 30,000 plus workers, announced restructuring in early 2025 that will gradually reduce civilian contractor positions by 2,300 jobs through 2027. When that paycheck stream dries up, the entire regional economy suffers. Retail at the Dayton Mall, restaurants in Kettering and Beaver Creek, service businesses throughout Montgomery County, all dependent on base spending. And then there's the corporate exodus. NCR moved its headquarters out of Dayton years ago, and other employers are following the same playbook. Downsize, relocate, disappear. What's making it even worse? Crime and education failures are creating a stigma Dayton can't shake. The violent crime rate is 2.1 times the national average. Dayton public schools face constant funding crises, teacher shortages, and declining enrollment. Families with children, the demographic that drives housing markets, actively avoid Dayton. They choose Kettering, Centerville, or leave the metro area entirely. That leaves Dayton proper, with a shrinking, aging, lower-income population that can't support home prices at any level. The victims are middle-income families who believed in Dayton's comeback narrative. They bought in neighborhoods like Belmont or Twin Towers for $175,000 in 2022, believing urban revitalization would lift values. Instead, they're now holding properties worth $140,000 while owing $167,000 on their mortgages. They're $27,000 underwater. Monthly payments of $1,480. Before insurance that's jumped 38% in 2 years. Feel like financial suffocation. HVAC technicians, pharmaceutical techs, administrative staff. These are the people trapped, unable to sell without devastating financial loss, unable to refinance, because banks won't touch negative equity. Investors are in full retreat. The institutional buyers who gambled on Dayton's affordability are liquidating portfolios at significant losses. They'd rather take a 20% haircut now than hold assets in a market with no bottom in sight. Local landlords are competing viciously for a shrinking renter pool, dropping rents by 12–15% just to fill units. Property owners are bleeding cash monthly, and many are simply walking away, letting properties fall into foreclosure rather than throwing more money into the void. Banks see the danger. Mortgage approval rates in Montgomery County have dropped 31% compared to 2024. Appraisers are routinely coming in $15,000, $25,000 below contract prices, killing deals even when buyers and sellers reach agreement. The market has frozen. Dayton could lose another 12–16% in home values by 2028, potentially pushing median prices below $115,000. At that point, it joins Youngstown in the category of affordable cities nobody actually wants to live in. The birthplace of aviation now faces economic freefall, and the housing market is the black box recording the descent. Number 4. Canton. Canton, Pro Football Hall of Fame, Stark County seat, working class pride. All of it unraveling in real time as the housing market implodes. The median home price has plunged 18.9%, falling from $156,800 to $127,200. That's $29,600 in lost wealth per median homeowner in 1 year. Inventory has exploded by 109% since last winter. Homes are sitting an average of 124 days before selling, if they sell at all. According to Stark County MLS data, 61% of active listings have reduced their asking price at least once, with many seeing multiple cuts as sellers desperately chase a market that keeps falling away from them. But it's not just economic. The reason? The complete annihilation of Canton's industrial base, paired with catastrophic demographic collapse. Canton's population peaked at 116,000 in 1950. Today, 69,000 and dropping fast. The city lost 3.4% of its population between 2023 and 2025. Over 2,400 people simply left. When population decline accelerates like that, it signals systemic failure. No jobs, no opportunity, no future. Property values can't survive that reality. What's making it worse? Timken, Canton's signature employer for over a century, has been steadily shifting operations overseas and to lower-cost U.S. locations since 2020. The Canton facility has shed 1,800 jobs in 5 years. Each lost manufacturing job ripples through the local economy, eliminating 2–3 service sector positions. Restaurants close, retail vacates, the tax base shrinks. And then there's the psychological impact. When the company that defined your city for generations abandons it, everyone starts looking for the exits. And then there's the insurance nightmare. Home insurance premiums in Canton have jumped 44% since 2023 due to aging housing stock, increased storm severity, and insurers fleeing Rust Belt markets they view as high risk, low profit. Monthly insurance that cost $138 now costs $199. That's $732 more annually, a hidden tax that makes already struggling homeowners even more cost-burdened. The human toll is staggering. Families in neighborhoods like Ridgewood or Perry Heights who bought in 2021–2022 are financially trapped. They paid $162,000 at peak prices. They owe $154,000 on their mortgages. Their homes are now worth $128,000. They're $26,000 underwater, and that's before factoring in selling costs. Monthly payments of $1,395, plus insurance that skyrocketed, plus property taxes that haven't adjusted downward despite collapsing values. It's crushing. Police officers, school counselors, medical techs, middle-income workers who played by the rules are now stuck holding depreciating assets with no escape route. Investor behavior tells the real story. Institutional buyers who entered Canton during the 2021 buying frenzy are liquidating at staggering losses. They're accepting offers 25–30% below their purchase prices just to get out. Local mom-and-pop landlords are even more desperate, offering rent-to-own deals, seller financing, anything to avoid foreclosure. Rental vacancy rates hit 13.7% in late 2025, the highest since 2009. There simply aren't enough people left in Canton to fill the housing stock that exists. Lenders are terrified. Mortgage approval rates in Stark County dropped 34% year over year. Banks are demanding larger down payments, perfect credit scores, proof of job stability, anything to avoid lending on properties they suspect will be worth less in 12 months. Appraisals are routinely coming in $20,000, $30,000 below contract prices, killing deals and stranding sellers. The outlook is catastrophic. Canton could see another 15–18% decline by 2028, potentially pushing median prices below $105,000. The city that once represented American manufacturing strength now represents its complete collapse, and homeowners are the collateral damage. Number 3. Akron. Akron. The rubber city, Goodyear, Firestone, the summit of American industry. That summit? It's now an avalanche of collapsing home values and economic devastation. Median home prices in Akron have crashed 19.7%, falling from $171,400 to $130,600, a $30,800 loss for every median homeowner. Inventory has more than doubled, surging 114% since January 2025. Days on market have stretched to 131 days, nearly triple the 2024 average. And here's the devastating stat: 64% of all active listings have had price reductions, nearly two-thirds. Sellers are cutting asking prices by $25,000, $40,000, $55,000, and still getting no serious offers. But it's not just one crisis. The reason? The total structural failure of Akron's economy, combined with demographic freefall. Akron's population has collapsed from its 1960 peak of 290,000 to approximately 188,000 today, a loss of over 100,000 residents. And the decline is accelerating. Between 2023 and 2025, Akron lost another 6,200 residents, 3.3% of the population. That's not slow decline. That's exodus. Young professionals are leaving for Columbus, Cleveland, or out of state entirely. Who's left? An aging, economically struggling population that can't support a housing market. Even more concerning, the rubber industry that defined Akron for over a century is functionally dead. Goodyear moved its headquarters to Charlotte in 2023. Bridgestone's operations have been gutted. The few remaining tire manufacturing jobs are automated, a handful of technicians replacing thousands of workers. Meanwhile, the University of Akron, once an economic anchor, is in a death spiral of budget cuts, enrollment decline, and program elimination. When your flagship university is shrinking, your city is dying. What's making it worse? The foreclosure crisis that never really ended. Summit County has one of Ohio's highest foreclosure rates, 178 per 10,000 homes in 2025, double the state average. Banks are taking back properties faster than they can sell them. REO inventory is flooding the market, dragging down comparable sales. And then there's the crime problem. Akron's violent crime rate jumped 23% in 2025, making national headlines. Property crime is rampant. Catalytic converter thefts, break-ins, retail theft. It's created a perception problem that's impossible to overcome. Nobody wants to invest in a city that feels unsafe. The victims are families across Akron who believed in the affordable city promise. In neighborhoods like Firestone Park, Ellet, or West Akron, homeowners bought for $185,000 in 2022. They owe $176,000. Their homes are now worth $140,000. They're $36,000 underwater. Devastating negative equity. Monthly mortgage payments of $1,520, plus insurance that's jumped 39%, plus property taxes on assessed values that haven't caught up to market reality. They're financially suffocating. Nurses at Akron General, teachers at Akron Public Schools, mechanics at local shops, working people who made responsible decisions are now trapped in financial quicksand. Investor behavior has turned panicked. The out-of-state buyers who viewed Akron as an up-and-coming market are now dumping properties at losses of 28–35%. They're accepting any offer just to cut their losses and move on. Local landlords are facing 14.8% vacancy rates, the worst in decades. Rental prices have dropped 14% in 12 months as landlords desperately compete for tenants who are themselves leaving the city. Banks have effectively stopped lending. Mortgage approval rates in Summit County have cratered by 39% compared to last year. Lenders view Akron as toxic. Declining population, weak economy, falling values, high crime. They're demanding 25% down payments and near-perfect credit just to consider applications. Appraisers are routinely killing deals by coming in $25,000, $40,000 below contract prices. The market isn't functioning anymore. It's frozen. Economists predict Akron could lose another 16–20% in home values by 2028, potentially driving median prices below $110,000. At that point, Akron will have lost over 40% of its home values from the 2022 peak, Great Depression-level collapse. The rubber city that once powered American transportation now faces complete economic irrelevance, and the housing market is the clearest indicator of that terminal decline. Number 2. Cleveland. Cleveland, the mistake on the lake. Once America's fifth largest city, the Forest City, Rock and Roll Hall of Fame. All the rebranding, all the stadium investments, all the comeback narratives. None of it matters anymore. Cleveland's housing market is collapsing, and there's no stopping it. The median home price has plummeted 21.3%, falling from $182,600 to $143,700, a $38,900 loss per median homeowner in just 12 months. Inventory has exploded by 127% since last winter, flooding the market with desperate sellers and zero qualified buyers. Days on market have stretched to 142 days, with many properties sitting unsold for 6, 7, 8 months. And the most damning statistic, 69% of active listings have reduced their asking price. 7 out of 10 sellers have admitted defeat and slashed prices, some by $60,000, $70,000, $80,000, and still can't find buyers. But it's not just market forces. The reason? Cleveland is experiencing multi-generational economic collapse, demographic catastrophe, and systemic urban failure simultaneously. Cleveland's population peaked at 914,000 in 1950. Today, 367,000. The city has lost 60% of its residents in 75 years. And it's not slowing down. Between 2020 and 2025, Cleveland lost another 21,000 residents, 5.7% of the population. Every year, more people leave than arrive. Every year, the tax base shrinks. Every year, public services degrade further. Property values can't survive that doom loop. Even more concerning, the jobs simply aren't there. Cleveland lost its manufacturing base decades ago and never replaced it with anything sustainable. The eds and meds strategy, relying on universities and hospitals, can't support a city of 367,000, let alone the metro area. Major employers continue to downsize or relocate. KeyBank, Cleveland's largest financial institution, has been cutting jobs and consolidating operations. Medical Mutual laid off hundreds in 2024. The vaunted Cleveland Renaissance was always a media narrative, not reality on the ground. What's making it catastrophic? The city's infrastructure is literally crumbling. Cleveland's water system is over a century old, with lead pipes still serving thousands of homes. The roads are among America's worst. Public transit is inadequate and underfunded. The school system is in perpetual crisis, with some of Ohio's lowest test scores and highest dropout rates. Crime remains stubbornly high despite years of reforms. And then there's the weather. Brutal winters, gray skies for months, snow that makes the city feel like a frozen hellscape. People are choosing to leave not just for economic reasons, but for quality of life. The human impact is devastating across every neighborhood. In neighborhoods like Old Brooklyn, Detroit Shoreway, or Tremont, areas that were supposed to be gentrifying, homeowners bought for $195,000 to $10,000 in 2021-2022, believing the comeback narrative. They owe $185,000 or $198,000 on their mortgages. Their homes are worth $145,000, $160,000. They're $40,000, $55,000 underwater. Financial devastation. Monthly housing costs, mortgage, insurance that spiked 42%, property taxes have climbed to $1,700, $1,900. For IT workers, healthcare administrators, nonprofit managers, even higher-income residents are feeling the squeeze, unable to sell without catastrophic losses, unable to refinance out of bad loans, unable to move for better opportunities elsewhere. Investor behavior is scorched earth. Institutional buyers who poured money into Cleveland during 2021-2022, convinced it was the next Brooklyn, are liquidating portfolios at losses of 30–40%. They're done. They bought neighborhoods like Collinwood and Cudell, thinking gentrification would follow. It didn't. Now they're unloading properties to anyone who'll take them. Local landlords face 16.2% vacancy rates, the highest in 30 years. They're dropping rents by 18–20% and still struggling to fill units because there simply aren't enough people who want to live in Cleveland. Banks have abandoned Cleveland. Mortgage approval rates in Cuyahoga County have collapsed by 43% year over year. Lenders will not touch properties in most Cleveland neighborhoods at any price. They've seen this movie before. They know it ends in foreclosure. Appraisals are routinely coming in $30,000, $50,000 below contract prices, nuking deals before they can close. The few mortgages being written require 30% down payments, 720-plus credit scores, and proof of multi-year employment stability. The market is functionally closed to first-time buyers and anyone without substantial cash reserves. The foreclosure tsunami is building. Cleveland's foreclosure rate hit 194 per 10,000 homes in 2025, the second highest rate in America. Entire streets have multiple foreclosed properties. Zombie houses multiply every week as homeowners simply walk away from underwater mortgages they can no longer afford. The city can't keep up with demolitions of abandoned properties. Neighborhoods that were marginal 5 years ago are now effectively abandoned. Cleveland's future is not decline, it's collapse. Economists predict another 18–22% drop in home values by 2028, potentially pushing the median below $115,000. The city that once symbolized American industrial might now face as managed decline at best, Detroit-style bankruptcy at worst. The housing market isn't leading indicators, it's the final verdict. Cleveland is dying and every for sale sign is another obituary. Number 1. Columbus, suburbs. Wait, Columbus. Ohio's capital, the state's largest and fastest growing city. Yes, but not where you think. We're not talking about Columbus proper, which has stayed relatively stable. We're talking about the overbuilt, overhyped, over-leveraged suburbs that exploded during the pandemic and are now imploding spectacularly. Places like Hilliard, Grove City, Reynoldsburg, and Whitehall. These are the epicenters of Ohio's worst housing collapse, and almost nobody saw it coming. Median home prices in these Columbus exurban areas have crashed 22.7% year over year, from $328,400 to $253,800. Let that sink in. $4,600 in lost equity per median homeowner in 12 months. It's the steepest decline in Ohio. Inventory has skyrocketed 141% since January 2025. Days on market have ballooned to 156 days, over 5 months, with many properties sitting unsold through multiple seasons. And here's the apocalyptic number. 73% of active listings in these areas have had price reductions, many seeing 3, 4, 5 cuts as sellers realize the bottom keeps falling. But it's not just a correction from pandemic overbuilding, though that's certainly part of it. The reason? These suburbs became speculative bubbles driven by remote work assumptions that have completely reversed. During 2020-2022, these areas exploded as people fled expensive coastal cities or Columbus proper, believing they could work remotely forever from spacious suburban homes. Developers went berserk, building subdivisions at record pace, inflating prices based on unprecedented demand. Then everything changed. What's making it catastrophic? The remote work reversal. By late 2024 and through 2025, major employers including Nationwide, J.P. Morgan Chase, American Electric Power, and Cardinal Health all implemented strict return-to-office mandates. Workers who'd moved to Grove City or Reynoldsburg, thinking they'd only drive downtown occasionally, suddenly face 45-minute commutes each way. In a city without efficient transit, the housing that made sense for remote work became a nightmare for daily commuters. Mass exodus followed. Properties that were perfect for working from home became overpriced. Poorly located boxes too far from jobs. Even more concerning, the speculative overbuilding created a supply glut that can't be absorbed. In areas like Hilliard's Western Developments or Grove City's Southern Sprawl, entire subdivisions of 200-300 homes were completed in 2023-2024, all targeting the same buyer profile. But that buyer pool has evaporated. What remains is unprecedented competition, new construction sitting unsold, while existing homeowners desperately try to sell before values fall further. Everyone is competing for the same shrinking pool of buyers, and nobody's winning. And then, there's the infrastructure crisis nobody talks about. These rapidly built suburbs lack adequate schools, retail, entertainment, healthcare, all the amenities that make places livable. Families moved there for space and found isolation. The promised shopping centers and restaurants never materialized because developers went bankrupt during the downturn. Residents are stuck in subdivisions that feel like detention centers. Nowhere to walk, nothing to do, and hour-long round trips for basic errands. Quality of life collapsed, and property values followed. The victims are legion. Young professionals, families with children, dual-income households who bought for $340,000, $380,000 in 2021-2022 are now sitting on homes worth $245,000, $270,000. They're underwater by $70,000, $110,000. Financial devastation on a scale many didn't think possible in Columbus. Monthly payments of $2,400, $2,700, mortgage, insurance that's jumped 37%, HOA fees for amenities nobody uses, are crushing budgets. They can't afford to stay, can't afford to sell. Engineers at Intel's planned facility that's been delayed, IT workers at major firms forced back to downtown offices, healthcare workers at suburban hospitals, middle and upper middle income earners who thought they were making smart investments are now trapped in the worst housing market in Ohio. Investor behavior has gone from predatory to panicked to capitulation. The institutional buyers and mom-and-pop investors who bought these properties as rentals during the boom are now liquidating at losses of 35–45%. They're taking six-figure losses per property just to exit. Rental demand has collapsed as people move closer to jobs or leave Columbus entirely. Landlords are offering 2 months free rent, waiving deposits, including utilities, anything to fill units. It's not working. Vacancy rates have hit 19.3% in some developments, essentially ghost subdivisions with "for rent" and "for sale" signs competing for attention on every street. Banks are in full panic mode. Mortgage approval rates in western Franklin County and southern Delaware County have collapsed by 47% compared to 2024. Lenders view these areas as the riskiest in Ohio. Rapidly falling values, high negative equity, rates, economic uncertainty. They're demanding 35–40% down payments and will only lend to borrowers with pristine credit and substantial cash reserves. Appraisals are routinely killing deals by coming in $40,000, $60,000 below contract prices. Even when buyers and sellers reach agreement, financing falls through. The market has frozen solid. The foreclosure wave is building. As homeowners realize they'll never recover their equity and can't afford to stay, they're walking away. Strategic defaults are becoming common. Financially literate people making calculated decisions to let properties go into foreclosure rather than throw away more money on underwater assets. The suburbs that were sold as the American dream are becoming America's nightmare. Planned communities turning into foreclosure clusters. The outlook is beyond bleak. These Columbus suburbs could lose another 15–20% by 2028, potentially pushing median prices below $200,000. A total collapse of over 40% from peak prices. The areas marketed as the future of Columbus could instead become permanent economic dead zones. Overbuilt, underlived, underwater. Homeowners who bought at the peak may never recover. The speculation that created this bubble has given way to capitulation, and the bottom is nowhere in sight. This is Ohio's worst housing collapse, not because values started highest, they didn't, but because the fall has been fastest, the impact widest, and the recovery prospects bleakest. These weren't struggling Rust Belt cities everyone knew were in trouble. These were supposed to be the safe bet, the smart investment, the future. Instead, they've become ground zero for the greatest wealth destruction in Ohio's housing history. So there you have it. The top 10 Ohio cities where the housing market isn't struggling, it's collapsing. From Lima to Toledo to Cleveland to the Columbus suburbs, we've seen the same pattern repeat. Economic decline, population exodus, speculative bubbles bursting, and homeowners trapped in financial devastation. But this isn't just about Ohio. This is about what happens when housing markets become disconnected from economic fundamentals. When speculation replaces stability. When policy failures compound demographic trends. When the American dream of home ownership becomes a financial nightmare for millions. The broader implications are staggering. Ohio, the bellwether state, the heartland, the place that's supposed to represent Middle America, is experiencing housing market collapse across urban, suburban, and exurban areas. If this can happen here, it can happen anywhere. The Rust Belt collapse we thought was contained to a few struggling cities is metastasizing. The suburban overbuilding we thought was a pandemic anomaly is revealing itself as a structural crisis. What's the pattern? Cities that lost their economic base never recovered. Suburbs built on speculation rather than fundamentals are imploding. Areas dependent on single industries are collapsing when those industries fail. Places with declining populations simply cannot support housing markets. The math doesn't work. And policymakers at every level are either in denial or powerless to stop it. For homeowners in these markets, the message is brutal. You're watching your wealth evaporate in real time. For potential buyers, the message is complex. These might be opportunities, but they're also traps. Buying in a collapsing market means fighting not just against current prices, but against years or decades of continued decline. For investors, the message is clear. Stay away. The risk-reward profile is broken. The markets that look cheap are cheap for a reason, and they're likely to get cheaper. This channel exists to give you the unfiltered truth about real estate markets. No spin, no agent talking points, just data, analysis, and reality. If that's valuable to you, subscribe and turn on notifications, because these stories are unfolding in real time and we'll keep tracking them until the bottom is finally in. If you live in any of these cities, drop a comment. Tell us what you're seeing. Are we getting this right? Is it worse than the data shows? Your ground-level perspective matters, and this community needs to hear it. We'll keep watching Ohio. We'll keep following the data. And we'll keep telling you the truth, even when, especially when, it's ugly. See you in the next one.